employment taxes and knowledge that your client is not paying their employment taxes on their employees. Those are what we call 941 taxes. That is a 100% penalty to your client if they are withholding tax money from their employees. And you're doing their business returns, and you're preparing their 941s, and they're not submitting all of those taxes. You know they're not submitting those taxes. That is a real difficult problem for a tax return preparer to have, for a bookkeeper, for an accountant. Just this week in my office, we were notified of a client that is not doing it, already has obligations to the IRS exceeding $100,000. We, as soon as we have knowledge of that omission, we stop filing the 941s for the client. We're not going to report to the IRS that, oh yes, our client is supposedly submitting these taxes when we know we now have knowledge that they are not. It's very important. 720 taxes are the same thing. That's the 10% excise tax on things like tanning salons. And don't confuse yourself with what you heard in the media. Originally, in the new tax law, they were going to remove the 720 excise tax. That did not get removed. It is still effective to this day. There's so many things that either did not get removed or changed. It's important that you know that. The IRS is very, very, very tough on these penalties. These are called trust fund penalties, trust fund taxes. If you have knowledge that your client is not paying his trust fund taxes, you cannot omit that knowledge when you're filing tax returns. You need to file what we call abatements for them, for their penalties and their interest. Why should their penalties and interest be abated? There is a specific for that. Be clear. Different tax years under omission issues. Client didn't fail to omit something in 12, or 2013, or 2018, or 2017. Different years can be decided different ways by the IRS. They may assign different examiners to different years. Just because you're successful on 1 year on an omissional issue, maybe you get interest abated, penalties abated, does not mean you'll have that same success in other years. Okay, let's take a look at defining due diligence. You have a duty of due diligence. I just talked about a boat issue. The tax preparer has a duty to do their due diligence. What does it mean? Here's the definition. I repeat this definition every year, and I always get one of the words wrong. I just can't pronounce the word no matter how hard I try. Such a measure of prudence, activity, or assiduity as is properly to be expected from and ordinarily exercised by a reasonable, prudent man under the particular circumstances, not measured by any absolute standard, but depending on the relative facts of the special case. What do you really need to know is, do you reasonably think you have enough information to prepare the tax return? If you do not, you should not prepare the tax return. If a person comes in and says, I know I paid $6,000 in interest on my home this year, and now we have this new $10,000 limitation, right? Well, where's your 1099 interest form? Where's your form from the bank? Show me the documentation that you paid it. Where's your checkbook? Let me at least see your checkbook. Let me see who you wrote the checks to, and did you apportion interest? If they don't have that information, you're not doing your reasonable job. Where do we really fall? We really fall into these traps when we're dealing with the sale of property. It's the sale of investments. I digress a little bit. The sales and purchasing of cryptocurrencies, which are huge right now. All over the U.S. Massive issues with due diligence as it comes to tax reporting of those. Do you have enough information? Have you examined it? Has your client examined it? Have they given you the results? Is it reasonable? I said purchasing property. Whatever type of property it may be, not necessarily real estate. Do you have proof of their basis? Oh, I paid X dollars and I have that. Oh, but I put a new roof on this year. I put a swimming pool in another year. and they start writing down numbers. Is that enough for you to determine their tax-free basis in that tax return? I don't know. I don't know. It has to be what a reasonable person would expect. And the IRS expects a lot out of you. They do. So take a look here at section 10.22, diligence as to accuracy. And we're on kind of section 2 and 3 of this section. So in determining the correctness of oral or written representations made by the practitioner to the Department of the Treasury, you have a duty of due diligence as to the accuracy. So even if it's just, you are allowed to prepare a tax return based upon an oral representation. But is it accurate? And you're still subject to due diligence. And number 3, in determining the correctness of the oral or written representation made by the practitioner to clients with reference to any matter administered by the IRS. So if you're making any type of representation to either one, you're subject to both of those. Okay. Staying on this section, 10.22, staying on diligence as to accuracy, I'm on slide 26. The practitioner will be presumed to have exercised due diligence. For purposes of this section, if you do this, look at this. If you rely on the work product of another person, in other words, the client sends you their work product, or I send you a document, and I say, okay, this is the way the court decided, this is how I'm analyzing it, take the deduction this way. You're relying on my work product. You have that chain of custody. You are okay. You've exercised due diligence. If you've used reasonable care when you engaged, supervised, trained, and evaluated the other person. So even if it's another professional, you have to evaluate them. What did I tell you earlier about attorneys? We can't practice in front of the IRS if we're suspended. Wouldn't it be a good idea for you to check the bar associations in the states of the attorneys that you're working with, and the Department of Financial and Professional Regulation for CPAs, the IRS for an enrolled agent if you're dealing with one of them? You have a duty to evaluate the person of the information that you're relying on. Make sure it's a reliable representation. And take proper account of the nature of the relationship between the practitioner and the person. What is my relationship to the client? Is it an employee? Is it a family member? Is it a client of mine and a client of yours, which is a stronger bond between the arm's length of the transaction? If it's an employee or family member, you may have to take proper account of the nature of that relationship to make sure that the advice is reasonable and you've done your due diligence. It works even in my firm that way. If I work with a CPA in my firm, or I work with another practitioner in my firm, I have to evaluate their situation and what they're doing. Okay, let's take a look at slide. Now we're on 10.23. We're moving one section, and we're on slide 27. Prompt disposition of pending matters. You may not unreasonably delay the prompt disposition of any matter before the IRS. Kind of the funny note about that is that the IRS will most likely unreasonably delay. They are very slow and getting slower, unfortunately. It's not their fault. It's just the nature of the examinations. We see examinations today as we produce this program. Examinations can take anywhere from 6 months to a year. Appeals, even when I talk to appeals officers, sometimes they'll tell me, Roman, this file, I won't look at it. Let's say it's January. They'll tell me on the phone, they'll say, Roman, we're not going to look at this file until August. If you want to do something prior to then, let us know, make us an offer. We won't look at it until August if we don't hear from you. And that could be a typical delay that you'll see on their side, but you are not allowed to unreasonably delay. And you can significantly damage your client's options if you do unreasonably delay. And I don't just mean options of being successful with the challenge or the deduction, but I mean options such as offers and compromise, offers such as, or options such as installment agreements. You start to lose those capabilities as the longer that you go. And if it's reasonable time, agreeable to reason, that's the definition. Is it or is it usual? Again, typically a taxpayer should respond to an auditor in 30 days. And honestly, if an auditor gives you a time frame that's less than 30 days, it might be a little bit unreasonable as far as a response goes. I had that happen recently. I had that happen in a winter month where an auditor sent me a letter and said, well, I want your answer within a week. And it was a week prior to a holiday. And I contacted the auditor immediately. And I'm like, you know what? First of all, you're outside of your parameters. The letter you said your deadline was 30 days from then, but you wanted to hear from me within 7 days. It was a very much an unreasonable request. So for you, reasonability there to an auditor should be about 30 days. And take a look at the last bullet point. The taxpayer requests your representation before the IRS and your first contact with them. Contact them immediately. If the taxpayer says, Roman, I want you to help me. I got a letter from the IRS. Boy, you should send out your representational letter, communication, whatever it is, phone call. At that point, you're allowed to contact directly and do that immediately. For those of us that have a CAF number, and if you don't, you can get one. It's the central authorized, whatever the number stands for. We have a special practitioner priority line that we can call. It is quicker, much quicker. Typically, my wait time on the IRS is less than about a minute on the practitioner priority line. If you don't have a CAF number, look into getting one of those and being eligible to call in on that phone number. They've divided that number up a little bit now. It's a little different this year as we've started the new year. So just kind of pay attention to the new menu that they have in the front of that. But I still use that practitioner priority line. And reasonably, I can contact the IRS right away. We fax the POA. We fax it to the person we're talking to, and we fax it to a number in Utah so that it's in the system fairly quick. And it gets in the system within a couple of days, so they know we represent the taxpayer. Okay. 10.24. Just looking at assistance from or to disbarred or suspended persons and former Internal Revenue Service employees. A practitioner may not knowingly and directly or indirectly accept assistance from or assist any person who is under disbarment or suspension from practice before the IRS if the assistance relates to a matter or matters constituting practice. So you have two things in there to deal with. Are you trying to get assistance from somebody who is suspended from the IRS or disbarred? And is it really a matter constituting practice before them? If you're gathering data for your client, that's not constituting practice before the Internal Revenue Service. We defined that already. Are you helping with a tax return? Are you making a phone call to the IRS? Are you meeting with the client and the agent? That is practice. Gathering data may not be considered practice before the IRS. So think about the two things in that section. Take a look at B there. If you're accepting assistance, you may not knowingly or directly or indirectly accept assistance from any government employee where the provisions of 10.25 or any federal law would be violated. So take a look at that. So I had an interesting case happen under Section A there, subsection A. We had an attorney that was sued by the IRS for telling his bankruptcy clients that federal taxes would be released in bankruptcy court. So the attorney called our office. So we got a power of attorney over to the IRS and the IRS record. Well, the attorney then, after we had our power of attorney in place for that client, that attorney then gets disbarred from the state. You need to file the revocation of your power of attorney at that time. If you're receiving advice from them, and now you know it may not be proper, the omissions that they did, the advice that they rendered, they were disbarred from their state, and all of a sudden you have a power of attorney over a client of that nature in place with the IRS, that power of attorney needs to be revoked. It's not that easy. It took us 3 times to get a confirmation from the IRS that it was revoked. They do not like to send out power of attorney confirmations. Keep, my notes, I have highlighted, underlined it, keep working on those revocations. If you ever need to revoke a power of attorney over a client, keep working on those power of attorneys until you get that confirmation from the IRS. Okay. 10.2.4, how to determine if a professional has been disciplined. And I give you two sites here that are potentially, the CPA, AICPA one, you may not find everybody on there. There are some accountants that are not registered with the AICPA, which means they don't hold a current certification. That just doesn't mean that they can't still do their practice. They just aren't a member of the AICPA. Different attorney firms have different websites. For example, in Illinois, we give you the Attorney Regulatory and Disciplinary Commission's website. That's what governs us in Illinois. It is not our local bar association. Give you an example, state of Arizona. Arizona does not have a regulatory commission. Arizona has just a bar association that governs their attorney. So if you want to check, you have to look at the state. State of Florida, the bar association in Florida governs its lawyers. They don't have a separate committee also. So take a look at state websites. For real estate, if you're trying to rely on a matter that deals with a piece of real estate, or a real estate broker, or you're dealing with a real estate company, take a look at the Department of Financial and Professional Regulation. Then you'll know if the person is licensed. Are they suspended? I mean, it's a quick check. If your client says, well, I don't remember what I sold it for, call my broker. They'll give you the information. Get the broker's name, get the state they claim they're licensed in, take a look at their Department of Professional Financial Regulation, make sure they're not suspended, and then you can rely on that information. That's due diligence. That's ethical conduct. That's what you're supposed to be doing. Okay, moving on to section 10.27 under fees. A practitioner may not charge an unconscionable fee in connection with any matter before the Internal Revenue Service. Example, you cannot demand $1,000 for a simple tax return. You cannot hold a tax return for ransom. Now, as the years go by, that example that we use, that number may increase. And yes, if a tax return is complex, or if it is a corporate tax return, or a trust tax return, or a partnership tax return, the fees can be much, much larger. Especially, though, going into the new tax law, knowing that we have significantly simplified the non-itemizable tax returns. And as much as we heard about a postcard filing, we will have the forms, and we will see how much of a postcard filing it will be for people with a straight W-2 or a 1099, and they're taking the standard deduction. They're not itemizing. Their tax return should be simple. And again, you're not allowed to charge unconscionable fees in connections with those matters. As a strong preventative measure, inform your client ahead of time of your fee. Get it in writing. Of course, you should be paid in advance if you can. If not, at the end of the tax return. But inform them as much as you can in writing. Typically, my office has a standard set fee unless we have to do different types of schedules or they present us with a complex situation. Staying on fees, let's talk about contingent fees. This is a very important section for you to know as a practitioner, and it's under subpart B, section 10.27, and then you have B1. I'm on slide 31. Take a look at this. So, except as provided in 2, 3, and 4 of this section, you may not charge a contingent fee for services rendered in connection with any matter before the Internal Revenue Service. But I have in bold below there, keep in mind, this is a general rule. So taking a look at this section, this is a general rule. A practitioner may charge, under, what did I say, 2, 3, and 4, may charge a contingent fee for services rendered in connection with the, when we say services right there, we mean with the IRS's examination of or challenge to an original tax return, or an amended return or claim for refund or credit where the amended return or claim for refund or credit was filed within 120 days of the taxpayer receiving a written notice of the examination. So, you have a statute of limitations, essentially what, about 4 months. You have about a 4-month statute of limitations where you have a window where you can file on a contingency fee basis with your client. So you cannot do it in the original preparation of the return. So you can't tell your clients, hey, I'm going to take as a fee 30% of your refund, whatever your refund may be. That is not allowable under Circular 230. That would be an ethics violation. But if they get a letter and they're being examined, or it's being challenged, and it's an original, or it's an amended return, then you can charge a contingency fee. You can tell them, well, if we're successful on this deduction claim, I'm saving you X amount of dollars, and I want to take 1/3 of that as my fee. Or I want to receive 1/2 of that as my fee to represent you in this matter. Because I've done my due diligence. I believe your representation is accurate and correct, and therefore I can do that. Okay, and look at section 3. You may charge a contingent fee for services rendered in connection with a claim for credit or refund filed solely in connection with the determination of statutory interest or penalties assessed by the IRS. So when you're saying this, now you're saying we can have a contingency fee when we're doing a claim for credit or refund, which is somewhat similar to preparing a return, right? Right. But it's only if we're doing it in determination of interest or penalties. In other words, was it late? Was there a penalty involved? The 941s we talked about earlier. Are you doing an abatement form? Are you trying to abate the interest and penalties that are being assessed on the 941 or the 940 or the 720 or whatever you're filling out for them? Is there an amount of that you're arguing for abatement, and therefore you could charge a contingency fee on that amount? We keep those, that's why those two have to tie together. So this is the return I prepared. We have penalties, we have interest. I don't know why, we have them. I can charge a contingency fee in trying to help for services rendered with that determination. And I always tell you, always try an abatement, always. I then take a look at section number 4. A practitioner may charge a contingent fee for services rendered in connection with any judicial proceeding arising under the Internal Revenue Code. And 99% of the time, this is going to be in what we call tax court. Because the IRS, the way this works, the agent makes a decision. The supervisor reviews the decision with the agent. Your client disagrees, you go to an appeal. You disagree with the appeal, then you have the right. You may even have the right before you go to appeal, but after appeal, you absolutely have the right to go to tax court. Once your client's in tax court, if you have to render services to them, now remember, you're very, very limited at that point in time of the services you can render as a tax return preparer. But once you've gone to tax court, once your client has gone to tax court, hopefully not you, once your client has gone to tax court, then you can charge a contingency fee regarding the services that you are providing.